Welcome to the inaugural episode of Kurv Your Enthusiasm. I am one of your hosts, Howard Chan. This podcast is a discussion of everything relating to investing and everything adjacent to it. Since it's our first episode, we figured that we give an idea about what the format of the podcast would be. So we aim to make this podcast roughly 20 to 30 minutes, although today's episodes will probably be a little bit longer since we have to do some intros. Each episode will be timestamps because the market moves very fast, and we're recording this right now on January 20th at around 1:40 p.m. Eastern Standard Time. The show is meant to cover global markets. Our investment philosophy is that while the U.S. has the largest market in many respects, it does not exist in a vacuum, and events and policies elsewhere in the world will have an effect on the US market and vice versa. So we split this podcast into two halves. The first half is a discussion about the markets at the moment, something that is relevant. And the second half of the podcast will look to go through or explain something that's technical. It could be a trade or something that's mechanical in the markets that not a lot of people talk in depth or in much detail. The show is meant to be a podcast, but you may also find a visual version of this on YouTube. I guess many podcasts are doing this, even though it's just really two talking heads talking to each other. But what you may find useful is that in the second half of the program, where we do cover a trade, if we did our job right, you should understand everything we're talking about through the audio. But in case that you're into numbers, we will actually show the spreadsheet and walk through all of the numbers on the YouTube version. So there's something visual for you to follow. This podcast is being created through Kurv Investment Management. It's a TF provider, but we're actually not going to talk about our funds on this podcast. This is purely about talking about markets, what we see, where we see the markets going. So if you want to find out more information about those funds, you should go to curvinvest.com. It is probably very, very important to note that the trades that we talk about on the show are not meant to be financial advice. Everybody's financial situation is very different. So it's very hard to, talk so broadly about a trade and how it's applicable for your own personal portfolio. And I guess the last caveat is that, of course, all of this is subject to change as we get feedback over the show and we iterate over what is the most interesting for you, the audience. So we will change things around based upon your feedback. So it's very important that you provide those feedback. So now that we've gotten that out of the way, I guess we should do some intros. So Dom, our other host, why are we qualified to talk about the markets? Tell us about yourself.
Well, I'm the portfolio manager at Kurv, but I come from a more fixed income background. And my first job actually was a fixed income derivative trader in Paris. And then I did 16 years at PIMCO in London, mainly on short-term products. So it was the management of the European portion of the whole of PIMCO portfolios. That means dealing with products like repo, deposits, short-term bonds, but also things like foreign exchange for the hedging purposes. And that said, I also have experience in other products on the execution side on longer bonds and derivatives on that. Maybe I should mention what is related to Kurv as well. I was the capital market person for the PIMCO ETF in London. And I guess that's where I met the person who was responsible for most of the growth of those ETFs. And that was you, Howard, right?
Thanks, Dom. So you'll notice Dom is very humble, which is an unusual trait for a portfolio manager, but he is a wealth of knowledge. So as for myself, I am the CEO and founder of Kurv Investment Management. I actually come from a very different background. I was trained as an engineer in electrical engineer and computer scientist. My specialty was signal processing for those who are a little bit nerdy. But ultimately, I decided to go into finance. One of my first jobs was actually at Goldman Sachs Asset Management, doing asset allocations for a large pension funds. And then ultimately, I wanted to learn more about global macro and security. So I moved to PIMCO, where I first started managing the global fixed income business, which is sort of what I call the everything in the kitchen sink portfolio. You see not just fixed income securities from the US, but all over the world, and how people think about rates, currencies, different volatility, different risk premiums that's in the market. And ultimately, I moved to London to build out PIMCO's ETF business there. So I have had a pretty interesting perspective in terms of the whole investment landscape, starting from really, high asset allocation, and then from a security level, not just on fixed income, but equities and commodities. And then ultimately also a unique perspective in how the business is developed in the ETF space. So hopefully all of this will provide some insight to you about how we view markets at Kurv and where we expect the markets to go. For the very first episode, Dom and I talked a lot about, what should we actually cover in our very first episode. And I think we both pinned it to a very key thing that we think underpins all investment in financial markets, and that is short-term interest rates. It's not a surprise that, or it's well planned that we're releasing this first episode late mid-January. That's because at the end of this month, on the 28th and 29th, we will have the first FOMC meeting for the year 2025. And we wanted to provide some context of why that is important. For me, interest rates is extremely important because essentially it is the cost of money. And that influences entities on all sorts of levels. The way I would split is on three different levels. So on the government and sovereign level, second on the corporate, the business level, and the third on the individual level. So Dom, let's talk about how does short-term interest rates influence on the top level, the government sovereign level, in terms of borrowing?
Sure. On the government, they will have, I would think of two and maybe more. The direct effect will be on the cost of borrowing new flows. If the Fed funds goes up right now and the bond market interest rates goes up, the budget deficit that needs to be funded, right, from the government will have to have a higher cost. Now, it's not only this budget deficit, but it's also the stock of the debt that's already borrowed. So that's a second level, I would think. And on top of that, the government interest rate curve from 1 day to 30 year influence as well other assets. So the higher the rate, the lower the price of assets. That's what I would do.
Yeah, and for government borrowing, that has the effect of essentially how much money they are able to finance for various different policies, right? That's within a particular country. So how going down the next level, so from the sovereign level to the corporate level to businesses, how do short-term interest rates then affect that?
A bit of the same way on the macro side. So the higher the interest rates, the more costlier it comes to borrow for a corporate. That means,
I get to maybe say here is that a lot of corporate bonds or corporate bond rates is as a base rate that's set from the government rate. So it's a government plus X percentage or basis points. And so wherever the government short-term rate is set essentially where the corporate borrowing rate is.
Yeah, exactly. So that means if the government rates goes up, the corporate rates will go up and their financing will be more costly. And that will impact their bottom line, the earnings. And if it means lower earnings, it means lower stock prices. And So that's on the financial side, but on business decision side, they will have to compare or maybe scrap opportunities that could have opened up if interest rates were lower. So for example, if you have your internal rate of return, which is 10%, and interest rates are also 10%, well, there is no point of taking risk to invest in something that you just could put your money on the treasury without such a risk, right? So that's another way to that impact.
That's a great point, actually. So if government rate is at 5%, which is the market assumes risk free, which we'll talk about. Maybe that's not so true, but like let's assume, a short term T bill is at 5%. Really to generate to make a business decision that's feasible is you have to find projects essentially that generates more than 5%, or else why would you take the risk? You just put your money in a government bonds and get that 5% yield, right? So your risk has to be compensated. So your return has to be greater than what the risk-free rate is. And, if the risk-free rate is higher, that means the hurdle of finding more projects that generates more than that risk-free rate is higher, then it makes capital expenditures a little bit more difficult to find those opportunities. I think the other thing to mention also, it does have effect on stock prices. So, oftentimes a lot of, equity analysts, or when you're doing your own analysis of companies, you're looking at what this company can generate in terms of earnings for the next 2, 3, 4, 5 years. $1 today is worth more than $1 tomorrow. So, you have to discount that future earnings by some rate. That's usually key to the short-term interest rates. So when rates go up, those future earnings then are worth less. And so that actually has an effect on stock prices. You see this a lot with technology stocks, right? Where in the short term, it's very sensitive to interest rates because a lot of the earnings are discounted, or I say revenues. A lot of technology companies don't have earnings. And so the technology companies are really priced on growth, what the potential of future growth is. And when interest rates are higher, that potential goes down. And therefore, the stock price then also adjusts downwards. So it does have effect not just only in bonds, but also in equity markets.
You can see a difference in the stock when interest rates rise. Some companies will be even more affected because they have debt to refinance.
It hits both the equity side and the fixed income, the debt side, right? Liabilities, yeah. So, and then I guess that the third bucket is probably the most important, is like, how does this affect the individual when a short-term interest rate changes?
Yeah, mortgages, I guess, and credit cards. A bit like the same way of corporates. The higher the rates, the higher the cost it will be to have a house, to buy a house, to make an investment decision, or a spending decision in a way of having more spending via credit cards, right? So that will be the direct effect. And the indirect will be the wealth effect from what you own in stock. If the stocks goes down because of interest rate rise, then you will feel less wealthy and maybe even spend less. And the spending might actually happen also. So you'll have less spending from households, less spending from corporates. In the end, spending and income are related. So you might have a slowdown in the economy. Then inflation. And at the end of the day, that's what the Fed wants, right? They just want to target inflation.
Yeah. Going back to your point about mortgages, that's pretty important. In the US, mortgage rates are kind of keyed off of the 10-year government treasury rate. So the higher it is, the mortgage rates goes higher, and that makes housing is less affordable. In the UK, mortgages, you usually can get 2-3 years fixed in the front end, but then it turns into floating after that. It has effect on what the fixed rate that you get. And then once it turns into floating, it definitely has an effect on the affordability of houses in UK and elsewhere in the world. It's a very unique product in the US that you can get a 30-year mortgage. Most places in the world, I think a lot of it is you can maybe get fixed, but 15 years, or generally there's a lot of mortgages elsewhere in the world that's fixed for a few years and then it turns back into floating. Short-term interest rates is important. All we've talked about is domestically, right? For US short rates, how much that affects US government borrowing, US corporate borrowing, and ultimately individuals in the US, how much they can borrow. But short-term interest rates between different countries is also very important internationally, the relative between the two rates, because it determines, has a strong effect, a determinant of currency values, so FX rates. We'll definitely do an episode why, seems like all of your friends are going to Japan for vacation. Differences on short-term interest rates has an effect on trade flows. I believe there's just an article in the New York Times or Wall Street Journal that said, China had the largest trade surplus exports into the rest of the world. And that for sure is due to the strength of the dollar, which has an effect of, due to the level of US short-term rates relative to short-term rates elsewhere in the world. And then lastly, the one I think to think about is that it has definitely effect on commodity prices. Most commodities in the world are priced in dollars. So especially US short-term rates has an effect on prices on those particular assets. Well, so we've talked about a lot about why short-term interest rates are important, and I'm sure we'll come back to this in later episodes. But I think it's then now we could go into maybe the second half of the podcast, which is how does it actually work? So Dom, given your expert in short-term rates, can you at least, let's use US as an example. How we talk about this interest rates, and it seems like the Fed has some effect on it. So actually, how does the Fed set these short-term interest rates?
So they target the very short-term part of the whole interest rate curve. They target the one day borrowing cost. And they target the one-day borrowing cost between banks that lend and borrow in order to meet their liquidity requirement at the Fed. So banks have a lot of balance sheets, enormous amount of money, and as a security, they need to have some cash somewhere safe, which is the Fed. And in order to meet their liabilities, their reserve, their requirements, then they borrow and lend money on the Fed fund rates. That's
so right now, the Fed funds rate is a window of 4.25 to 4.5. So how does how do they mechanically actually keep the rates, short-term interest rates within that range?
So the Fed, so the Fed fixed the lower bound and the higher bound, 25 to 450, and they want the Fed funds in between. Right now it's 433. If the rates of the Fed funds, which is not traded by the Fed, it's just influenced by whatever the Fed does. If the rates of those Fed funds go below or above, they will do open market operation in the name of repo or reverse repo.
So those are repurchase agreements and reverse repurchase agreements.
Exactly. Depending of which counterparty you are with, you either do a repo or a reverse repo. So if the Fed fund rates, let's say the Fed fund rate is above the upper limit. So right now the upper limit is 450. Let's say it's 460. The Fed will say the rate is too high. Why the rate is too high? It's because there's a lot of borrowing going on. Banks can't find enough money at the upper band, so they have to find money above the upper band. There is not enough liquidity. So the Fed needs to inject liquidity. And the way to inject liquidity, they will just purchase a bond from the bank today and sell it for tomorrow. Okay, so that's that's a repo or reverse repo, depending on which counterparty you look at.
So the Fed targets a rate between 4.25 and 4.5, and so that's a target. So if the realized rates goes above 4.5, that means that there is a lack of liquidity in the market. So in order to inject the liquidity, uh, the the bank has some sort of assets, let's say a government bonds that's kind of stuck, right, on the bank balance sheet. It needs more money on the bank balance sheet in the reserve. So the Fed will buy that bond from the bank and then give it in exchange cash. So that injects liquidity into the market.
Exactly.
And
And they will reverse it the next day.
you reverse it the next day. And then that
And those
should
two
bring,
legs, it's one trade.
and then so that should, by injecting liquidity, that should bring the rate back down to 4.5.
Yes, if you do that in an enough amount, the rate will go below the upper limit.
So in reverse, right? So let's say the bottom of the target is 4.25. So let's say, what about the realized rates at 3? So that means that there is what? Too much liquidity in the market.
Exactly, yeah. Too much
So how does the
liquidity,
Fed sop up that liquidity?
they will do the opposite. They will sell a bond to the banks, and will buy it back one day later.
It would take cash away from the banks in
Exactly.
exchange for
Just
that
for one
bond.
day. And the next day, if the rate is still below, they will do that again and again and again until the rate goes back up.
Well,
Not
that's
too
interesting.
difficult.
The ability to essentially manage liquidity in the markets, right? I think one of the things that we wanted to also talk about is, if you're anywhere close to financial news or markets, you know that right before a Fed meeting, all of these reporters or markets will comment on, oh, there's a X probability, 80% probability for a 25% rate cut or 50% rate cut. How do actually these reporters or markets know what the market thinks about these probabilities? So today we're actually also going to talk about how they figure out what the market expectations in terms of how many, the size of the rate cut that's in the market. So for those who are on the audio version of this podcast, Dom pulled up a spreadsheet on screen. So this is for the YouTube version, in case you're interested in the numbers. But we're going to talk about it, so you shouldn't need it. But just in case you're curious, there's a visual version of this.
Sure. So what does the market do to figure out what the future Fed fund is? They use the future prices on futures from the CME. They are called the 30-day Fed fund futures. And they go from January 2025 to, I believe, January 2029. Every month, you have a Fed fund future. So in theory, if you want to go, or if you want to be quick, without having to calculate many spreadsheets, you just take the expiry you want, and you will know more or less the Fed fund futures of the day. That said, and maybe I should explain what the future price is, right? Because the futures price usually in a bond, it's quoted at as 100 as a base. But here we have an interest rate. So the way the CME does it is they use 100 also as a base, and then they subtract the rate of the Fed fund future. So you get the future price of the Fed. So, for example, if the Fed fund is 5%, the future will be 100 minus 5. Okay, so 95. That's the way they do it. Now, if we want to be more precise, because the Fed funds are accruing every day, but only from one calendar month, so for the 1st of Jan to the 31st of Jan. And because the FOMC is not setting the date exactly at the beginning of the month or the end of the month, and actually it's only 8 times a year this year, you have to accrue instead from FOMC date to another FOMC date.
So you have to make adjustments on the futures to make sure the rate of the Fed fund meetings from the beginning of the period to the Fed funds meeting. So meaning, even though the futures is from January 1st to January 31st, your Fed meets on the 28th, you really need to only accrue for the first 28 days of that price.
Yes. And for example, the second Fed fund this year, is 19th of March, right? So you have to accrue between 29th of January to 19th of March. But it's not complicated.
The Fed doesn't work on the CME calendar?
No. But yeah, it's not too complicated. What you have to do is interpolate. Well, you can do that automatically, but you can guess what the Fed fund rate is for every date up to a year. So that's what we do right now. And you need to compare that to your future prices. So the future interest rates from the futures, which is the reality of what the market expects, should be what your interpolation. So the difference should be 0 at the end of the day. From a calendar accrual to FOMC to FOMC accrual. That's the way to do it. Now, there's some guys who will say, oh yeah, you can use option pricing and things like that. You could, but this is rather robust and easy to do, and pretty precise.
So looking at the prices now, right? Let's go through what the market is telling us right now. So as of January 29th, which is the next Fed meeting, the market is expecting the Fed funds rate to be 4.33%.
Which is the same as the Fed funds today, which means there is no expectation of any move.
But if you go out a year out into January 28th, 2026, the market expectation is 3.96%. So that's about a 37 basis point drop.
37 basis points drop for the full year. But since the Fed doesn't work in 37 basis points, they don't cut or raise rates in 37 basis points. So they do it in 25 basis points increment, so 25, 50. That means your 37 are 1.5 rate cuts for the whole year. So the market expects right now 1.5 rate cuts for the full year. That's what you can do.
So it's 100% for one rate cut and then roughly 50% for a second rate cut.
And you can do that for all months. For example, let's pick March. So 19th of March, the Fed fund rate is 4.25. So it's 8 basis points down from today. That means 8 divided by 25. It's a 32% probability of a rate cut.
No, I mean that this is a huge change. I think this is actually a really important point that I think it's been ingrained in both of us, which is that in order for you to make a return in your portfolio, your view actually has to be contrary to what the market is, right? Because right now, if your expectation is that there's only going to be one rate cut, 25 basis points rate cut for all of 2025, you're too late. It's already been priced into the market. The futures market has already been priced. So your view has to be somewhat different than what the market expectation is now in order to, make or lose money, right? So it could be the case that what the market is expecting is true, but that has already been priced in. And it's kind of interesting. So on Dom's screen, he has the rate path that was expected as of September of 2024, so last year, and now January 2025, and the rate looks very, very different. In September of last year, the short rate they were expecting roughly about 5%, and then going into January 2026, they were expecting the rates to be at 2.75. So that's a rate cut of 2.25. So that's a 5 rate cut in last September. And now in January, we're roughly at 4.33, and then going into January 2026, it's at 4%. So that's really one full rate cut. So the market expectation dropped from 5 rate cuts to 1 rate cut. And so if in September you said, hey, the market is overly generous, thinking there are too many rate cuts, and I think there's going to be less. How would you have positioned that, Dom, in order to generate return?
So if you knew beforehand that the January 2026 will go from 2.8% to 4%, you will have to sell the future. So you will sell the future January 2026. It would have been at 100 minus 3, so 97. You will sell that, and today it will be, it's 100 minus 4, which is 96. So you would have made 100 basis points, or 1% out of that. Now you have to be careful on the future because of the denomination. It's a 1 month future. Okay, so the duration, you have to take that into account. But you have to have a multiplier on top of that.
Yeah. Well, one of the things that we want to do here is a lot of investment managers usually talk about the markets, but they either give you only one of two pieces of information, either how they think the markets are going to go, what their position is, or when it's going to happen. A lot of people don't give you both pieces of information because it gets them kind of stuck in a corner if they're wrong. But we're going to put ourselves, Dom and I are going to put ourselves in the hot spot, which is for the duration of 2025, we're going to keep track of how accurate we are in terms of our rate predictions. For myself, I don't really forecast more than maybe 1 or 2 meetings out. So, the further you go out, the higher the probability of uncertainty. Right now, you'll see a lot of Wall Street analysts doing a prediction of all of 2025. I don't really know how they do that. Most certainly, with 99, 100% probability, they will be wrong by the end of 2025. So we don't want to do that. So we will forecast based upon the information that we have, probably 1 or 2 steps out. And I think this is also important in terms of talking about sort of our views in terms of going into this new year. So Dom, I think maybe let's kind of talk about our prediction, but in 2 different steps. One is, what do you think is going to happen at this January rate meeting? And then second, we don't need to talk about where rates are going to end in 2025, but largely what sort of factors are you looking for that will determine the rate path for the remainder of 2025?
So for the January meeting, we come from good numbers on macro side, on the employment rate or unemployment rate, on the growth as well. And the inflation, even though stabilizing, it's still a little high. And that's probably why I and the market expect no cut this January 2025. There's like zero cut expected. Going further out, to me, I will look for more rate cuts than what is priced at the moment. So it's priced, one rate cut up until June and 1.5 until December. I will think there are some deflationary effects coming. Also, I like to look at real rates. Real rates, at the end of the day, are the rate that the companies have to pay away from the inflation. And right now it's in the 2.5%, which will be problematic to refinance the debt or to have new projects to do. So it will dampen the earnings at the end of the day, dampen the stock and the ability for companies to hire. So I will go from maybe 3-4 cuts rather than one. What about
So
you?
then you would long the futures.
Yes, I will long the future.
Yeah. So from my perspective, I agree with you in terms of this particular January meeting. I think we just came out 50 basis points cut and another 25 basis points cut. And the reason why the curve right now has repriced to almost no rate cut is because a lot of Fed chairmen, their forward guidance has actually decreased quite a bit. So the market has repriced saying, oh, there might not be additional rate cuts. So for the first part, I agree with you. There probably will not be a rate cut in this next meeting. But I have a different view for the remainder of 2023, which is I was actually not surprised that the Fed governors actually lowered their forward guide or removed rate cuts in the forward guidance. Largely because we're recording this on inauguration date. Is that the Fed doesn't really know what fiscal policy is going to be, right?
That's
and
true, yeah.
If the new administration is going to implement many of the things, the policies that they talk about on the campaign, primarily a stricter immigration policy, which will decrease the labor force, depending on how it's implemented, where they're going to remove labor force, and then in terms of tariff, again, depending on how they're implementing it, those tend to be inflationary. So why promise more rate cuts now when fiscal policy is so uncertain? So while I don't know if one rate cut for all of 2025 is correct, I think there'll probably be a bit more. I think it's wise that the Fed removed these rate cuts off of the table and be a little bit conditional in terms of how these policies filtered into the economy and how that's going to affect growth inflation. I mean, inflation has come down a bit, but it's still higher than what the target is, right? Labor force is very strong. The economy tends to be still doing pretty well relative to the rest of the world. But we've seen a little bit of cracks where, savings rates come down, and, how whether the economy can continue on its trend is a question for me. So that's my outlook. So I think both of us on the scorecard is no rate cuts for January. So we'll put that in the book. And I guess that's unless Dom, you have other things to talk about, this is concludes the first episode of Curv Your Enthusiasm. Before we go, we just wanted to mention that Curv is based out of California, and we have really strong presence in Southern California. So we're definitely feeling for the victims of the fires. That's still happening in Los Angeles. There's another bout of Santa Ana wind that's coming out next week. So we want to support all of our friends and partners in LA. And we've left some organizations that if you want to donate to help those folks that really now at the moment could use a helping hand. And so with that, that's our first episode, and it can only get better from here. So if you like the episode, we really ask you to do us one of three favors, maybe all three. The first is like this episode so that other people can find it. I'm told that that's how the algorithm works. The second thing is tell other people about this podcast and subscribe. The more people, that listens to us, we get more feedback. And that's actually the third part, which is, we want the show to cover things that you're interested in, right? So is there a particular trade or a particular market that you want us to discuss? We would love to hear from you. We want to make this as useful as possible from you. So if you have any comments, please leave it in the comment section, and we will endeavor to take those feedback and make this podcast better. If you have any topics you want us to cover or have any feedback, please send an email to podcast@kurvinvest.com, KURVINVEST.com. We will read it. We'll read every single comment and try to make improvements on this podcast. We got the next few episodes planned out. The next episode, we plan to cover a Bitcoin arbitrage trade. So that would be very interesting. So stay tuned. From Kurv Investment Management, thank you for listening to Kurv Your Enthusiasm.